Go. Hey everyone, good afternoon. Those who don't know me, I'm Madhav Rajan. I'm the Dean at Chicago booth and also the George Schultz Professor of Accounting here. It's great to have you all as we welcome our alum, Mark Hoplamazian, President and CEO of Hyatt, back to booth for our Distinguished Speaker Series. And you all know this is a long-standing booth tradition. We bring in leaders from the community, from industry, from the government to come back to booth and speak about their insights and experience. And we've had lots of great talks over the years with many different alums. We started doing some of these virtually during COVID, and we kind of keep doing that today. We did a virtual event with Mary Tolan, if you remember, from Chicago Pacific Founders, just a few weeks back. But it's great to be in person and particularly to do events at Bleacher. I think the last one we did here was with Gerald Beeson from Citadel, again, a few weeks ago. So I'll give a brief introduction to Mark and then ask him some questions. And then I'll turn it over to you, in about like 30 minutes or so. So please come up with some things you want to discuss. So Mark was appointed to the board of Hyatt and was named president and CEO in 2006. And before that, he worked at the Pritzker organization, which is a financial and investment advisor to many of the business interests that the family has. And as part of that, I think he did some work for Hyatt as well and for some of the predecessor companies. And before that, he worked in M&A at First Boston. Mark serves in lots of different roles in the city and across, corporate boards, civic boards. He serves with the Commercial Club, World Business Chicago. He's on the board of trustees of the Aspen Institute. I think he's the vice chair there. And this spring, Mark was honored with the 2024 Distinguished Alumni Award from Chicago booth for the corporate category, which is the big category. So thank you very much, Mark, for being here.
Thank you.
So maybe to start with asking, what were you doing prior to coming to booth and sort of what led you to the decision to come to Chicago booth?
Well, I was on Wall Street for a couple of years, and I went to Harvard undergraduate, and I knew I didn't want to go to Harvard Business School. That sounds like it's a loaded comment, but really, at the end of the day, the way I looked at Harvard Business School was, if you wanted to hone your interpersonal skills and how to work with people and engage with people, the case method that they really were very strict about was designed to do that. But actually, working on Wall Street and having, I hate to say it this way, but having a relatively weak boss that I worked for who was very relationship driven, just not very finance expert. He wasn't much of a finance expert. Left me in a very uncomfortable position several times, including in front of the investment committee of the whole firm, because we took one of the things that we were working on to that investment committee, and he couldn't answer some of the questions, and I was put on the spot, and I actually couldn't answer one of the questions that was put to me too, and I felt horrible. I said, "There's no way I'm going to build a career in business without having the strongest skill set that I know, the confidence walking into a meeting that I have the ability to understand and think through things." And so I said, "Yeah, Harvard's out." Chicago was my first choice because it at that time had the reputation of like, you come out of business school from Chicago, you know your shit. Sorry, I guess I should not use that language because someone told me that it's going to be recorded, so I apologize to those who are listening. And I really felt that was really critical, and I already felt like I could get along well, so I was really excited about coming.
Do you remember much about your time at booth, like any classes or professors that sort of come?
Yeah, quite a few actually. So Eugene Fama was at that time like how do you say it? He was the biggest star on the marquee. And everybody was like revolving. He had like a vortex, a gravitational vortex around efficient market hypothesis and all of his courses. So he was a big man on campus. I understand that he kept on promoting himself as big man on campus for many years after I left. But I had great experiences with a couple of people. Raymond Weil, who was one of the co-authors of the accounting text that we used to use. Don't know if it's still in use. He named me the president of the class in our first class because I actually asked a question. He was using some kind of Socratic thing, and I said, well, doesn't that depend on whatever? And he said, wow, that's the best insight I've ever heard. You're now the president of the class. Everyone was like, who is this guy? So that was fun. And he was actually, even though he was very gruff, he was a great guy. Bob Blattberg, who left Chicago to go to Kellogg, it's the first marketing class I ever took. And I remember after the first month, I was like, what is all this math? Like, I thought marketing was going to be about, brand positioning and sales tactics and so forth. This thing was so analytically intensive. It was a big eye opener for me that, if you're in marketing, you got a lot of data that you can use and pour over. I took some organizational classes that I felt were fascinating. But, I came out of a finance background. I went straight into a family office role, largely doing PE and investing. So I was more finance oriented at the end of the day than anything else. And so, yeah, I had great memories actually of all of this.
And what brought you to the Pritzker organization? What was the connection?
I worked on Wall Street, and I was thinking about going back, but I didn't want to go back as a banker. I wanted to go back as in a role that I could be more involved in businesses and funds. It's going to sound weird, but this is 1989. It's a long, long, long time ago. And getting a job straight into any PE firm was unusual back then. And so there was a fund being formed in New York called the Water Street Recovery Fund. It turned out to be timely because it was all about distressed investing. But honestly, the person who was running it is someone so I got a job offer to go join it, even though I came out of my interviews with that guy not really comfortable that I would have a good mentor working relationship. Not because I'm so insightful and right all the time. In fact, I'm wrong more of the time than I'm right. He turned out to have some problems and ended up leaving the firm 3 years later. So I was really happy I had made that decision. And I was talking to a partner at BCG because I'd worked at BCG over my school years. And he said, what you're talking about is like a mixture of some consultancy work, but still very involved in making deals and the financial aspects of overseeing companies. And that's what we do. We, the Pritzker organization, the family office. And that was in November. He called me in March and said, hey, we're actually serious about hiring someone. Can you come back in? And 4 weeks later, I had a job offer, and that's how it happened. But it was, for me, the perfect mixture of helping businesses that were part of the portfolio, but also being involved in making new investments. And then he left within a year and a half of my joining, and I got to work with Jay Pritzker, who, if you don't know the name, was one of the founders of what a leveraged buyout was all about many, many, many years ago, and a brilliant guy. So I learned a lot. And the other thing I liked about the Pritzker organization is they had about 250 companies in their portfolio, maybe even higher than that, in so many different businesses. And I felt like I would always be learning something new.
Mm-hmm. And could you speak a little bit about your connection to Hyatt? I mean, did Hyatt even exist in those days?
Yeah,
In what format did it sort of?
Yeah, the family founded Hyatt in 1957.
Mm-hmm.
So it was around for a long time. And I would describe it as sort of like one of the companies in the portfolio. I know that sounds kind of silly, but it really was only about 20 or 25% of the total portfolio value. So it was big, but it wasn't like the vast majority of their holdings. There were several things that happened. The first Gulf War turned out to be a time of tremendous distress. And so 1991 was really bad. And Japanese investors who went crazy in the 1980s buying US assets, including building resorts in Hawaii, were seeing occupancies in January and February of 1991 in the 20s, 20% occupancies. And so for those of you who don't understand this, Hawaii in January runs 90%. It's the season. Like people, they take off December and January are like the high months. 20% occupancies, partly because the Japanese were told by the government not to travel. Nobody knew what the Gulf War was going to turn into, about which allies were going to get pulled in and how disruptive this was going to be. So distress was massive. And So I got called in to actually work with a consulting firm that Hyatt had hired to take a look at that and decide what were the opportunities coming out of this, not how do we need to defend ourselves. So I was involved in stuff like that, some financings, acquisitions, but not really involved in the business. And then the Pritzker family had famously or infamously had a food fight amongst the family members in 2001 when Jay Pritzker died. And we put a program together to unwind the holdings and basically distribute either shares in companies or cash value to 11 different family groups. And my team ran that process, and Hyatt was the first company we had to focus on because it was scattered everywhere around the Pritzker holdings. So I got to know everything there was about Hyatt, but not the business. And then eventually in 2006, Tom came to me and said he had decided to hire president and CEO for the combined company, international and North America. So he asked me to serve in an interim role, and I said, as long as they don't get stuck there, I'll be great. That was 18 years ago. And then I fell in love. Loved the people, loved the business. I thought it was very underexploited as a brand and as an enterprise. And so I ultimately became CEO back in December 2006. So 18th anniversary coming up 2 months from now.
So in 2006, then when you took that role over, you had no business experience with the hospitality sort of part. I mean, how was that? What did the...
I was in London at the London School of Economics during my undergraduate years, and I worked as a night auditor at a 3-star hotel on Edgware Road. That doesn't qualify as no, I didn't. So yeah, it was scary. And I came in and I said to everybody who I was working with, look, I really don't know the business. And I had a reputation from the Pritzker organization, which was, hey, this guy kind of knows his stuff and Jay and Tom really rely on him. So everyone was looking at me like, oh, don't give me that. Like, you got to be kidding me. And I was like, no, I really don't know. I don't know the business. I can tell you anything you need to know about the income statement, the balance sheet, the cash flow statement, the legal structure, the tax structure, anything you need to know about that. The business, if you put me in charge of a hotel, you will be sorely regretful of that decision. So I spent the first 9 months of my existence, it was like a completely vertical learning curve. And ignorance was my friend. I mean, first of all, people in hospitality are really nice. And when they heard some of the questions I was asking, they were like, oh my God, this guy doesn't know what the hell he's doing. So they were really nice to me and they leaned in and tried to help me. But it turned out that simple questions, I'll just give you one example. Simple questions like, so I see this customer service score and we're using the mean of all the scores that we've gotten in. So when you sit back I'm sitting next to a general manager on a bus on the way to a regional meeting. I said, so when I look at this cheat sheet, I had a cheat sheet for every hotel I visit to say, here's the financials, the management team, where they're positioned in the market, et cetera. So I said, this number right here, when you were a GM, how did you use it? And he said, well, if it were anything less than a 10 basis point change, like 4.07 to 4.17, I'd ignore it. I said, what's your guess about how much of the time it's more than 10 basis points of movement? He said, not that frequently. So I'm sitting there thinking, we do all this work, we gather this data, and I said, why 10 basis points? Why not 20? Why not 5? He said, I don't know, it just seemed like it was big enough. I mean, I'm not kidding. This is like the way the company was operating. I was like, anything about statistical significance, maybe, just out of curiosity. Or what the distribution was, like maybe that matters. Anyway, coming out of that, we both agreed, like he was sitting back and realizing how stupid it was. Sorry to say it that way, but that's the truth. And I went and started talking to people, and I went to Enterprise Rental Car. They said, yeah, average customer scores is irrelevant. We do a scale of 5, and top box is the only thing that matters. Why? Because people who give us a 5 are 80% likely to rent from us again. And when you go to a 4, it drops to like 10. It's like a complete cliff. So top box is the only thing that matters. And then I met with the guy who is the father of NPS and started understanding NPS. So there are many more things out there, but this is one of like 150 things that I was able to uncover. It's not about me. We did this together. Like I was asking questions and they're stupid questions, right? But the simplest questions are always the hardest ones to answer. So we learned a lot together and we made a lot of changes as a result of that, but it was all derived from learning as opposed to knowing.
So with this example, Mark, and the just the background you had, would you say that what you brought was more of an analytical mindset? And sort of-
Absolutely, 100%. And also, you know, we do a lot of development deals with many different structures. And I think Booth prepared me to be effective in the family organization. One of the reasons why I developed credibility with Jay and Tom Britzker is because I had a really, really strong, I came out of Booth with that which I had aspired to, which was a phenomenal skill set. So when they asked me to do something, I was able to do it, and with speed and understanding where the infirmities might lie and how to think about risk. And Jay's practice was always risk-weighted returns. He wanted to understand relative risk and return. And he was always looking for asymmetrical outcomes. And it was second nature to me to think that way. So it was really a great fit. But I wouldn't have been able to do that without the backdrop of what I learned here.
And so over time, as you developed your leadership style, like what would you say it was? Like at the beginning, or sort of what did it like evolve into?
Yeah, it changed a lot. So when I was doing deals primarily within the family office, I was, a typical deal person. I'm sorry for all of you who are in the deal world. There's no negative implications. But when you're doing deals, you're like, you've got straight deadlines, you're pushing and you're directing people a lot. When you're managing a company, you're listening, you're coaching, you're mentoring for a much longer period of time, like for something that will evolve over a much longer period of time. So I had two figurines in my office. One was Darth Maul, for those of you who are Star Wars fans. Vicious looking guy with the horn sticking out of his head, red face with a two-edged lightsaber. And Yoda. And that was the evolution of my management style. I went from Darth Maul to Yoda over the first couple of years of my tenure. I think the biggest thing that was hard for me to understand, I still miss it even today. When you're working in deals, it's an extremely flat and small organization. When you work at a company that's got a hierarchy and has lived that way for a long time, when you're the CEO, man, the shadow that casts and the implications that has, most of which are things I have to overcome as opposed to things I enjoy. There's no such thing as a power trip being a CEO. If you do play that, you don't last for very long. So it was understanding that when something comes out of my mouth, the implications down the organization are significant. Whereas if you're in a deal process, I might say something, could be wrong, could be off topic, and people get in your face about it. It's not like there's no deference to, he's the head of the Pritzker organization. Very different in an organization, like in a company, an operating company. And that shadow of the leader, so to speak, was something that took me a long time to understand and really experience.
And in that leadership role, of course, you also have to be the chief communicator, right?
Yes.
To the staff. I mean, once I met the former CEO of United, and he said he gave a particular speech 78 times.
Oh my God.
And I mean, I'm sure, so what is your communication style? Do you sort of walk around, talk to people, or do you sort of send emails, or how do you handle that?
Yeah, I try to do not as much by way of email. Every once in a while, something will inspire me or propel me to commit something to writing that I do want to share with the team or with the company. But a lot of it's video. And during COVID, we really developed we broke the habit of having to have high production value, highly polished materials, and we went low production value. In fact, virtually all of the videos that I posted during COVID, which were a lot, was my iPhone on a stand. That's how I recorded it. So very low res, kind of low production value. People just needed to hear like authentically and sincerely what's in your mind and what your outlook is. So that's always much more effective. In person's the best. Second would be video, and then third would be written.
So you mentioned COVID, which of course was a huge sort of negative shock to the industry. So maybe just speak about COVID. When did you realize this was going to be a huge problem, and sort of how did you think about getting your way out of it?
Yeah, it was March 12th and the world shut down that day. And by March 13th, we were in crisis management. Give you a sense of it, our month over month demand drop was 95%. So we lost basically 95% of our business in 1 month. And we ended up eventually shutting down hundreds of hotels around the world. We ended up making a decision to lay off close to 40% of our corporate staff around the world, which is unprecedented by a factor of like 50 of anything that Hyatt had done in its entire history. There were tens of thousands of people we had to furlough or let go. It was severe. I mean, it was really severe. There were existential questions about, survival. And this is going to sound really bizarre, but I stayed very close to a number of airline executives during the same period of time. Why? Because I realized that unless and until I understand when they're going to be back in the air and having regular schedules, we can guess at demand, but we won't have the ability to have people coming into our hotels, other than turning our porte cocheres, the places where you drive up in front of the hotel, turn them into like food delivery stations where restaurants were still open, producing meals, and we were selling them to locals. We did that in a whole bunch of hotels, especially in Asia. So I was staying really close to the airline executives, and most of the airlines at that time were losing cash losses well in excess of $1 billion a month. And I thought, and they were borrowing money from the government like it was going out of style. And I thought, geez, if I think I've got problems, that's a whole different level of problem. And it was. So I would say that's like a really extreme and contortionistic way to think about Misery Loves Company. And it wasn't really about making myself feel better. It was just understanding how severe things were. So I spent the first, sorry about that. I spent the first 2 months of my life during COVID raising money. And again, without, the background that I had and the training here, we did a very unusual asset-backed line, $500 million. And super complicated. But I hung with all the product guys. Goldman Sachs was the firm that we hired to help us. And we worked through the whole deal. We actually ended up signing the deal between the time I started and the time that we were ready to take down or have that available and go live. The bond market opened up and we raised $900 million in the bond market, which was shocking to me. I never thought the bond market would get back to that level so quickly. And so we ended that whole thing took me almost 2 full months to put into place and a few years of my life. And we had it open for about 6 hours. We signed it and then terminated it in the same day because we just raised all this money publicly. So I would say in the same way that I had to go and now think very differently about things like financing, which are second nature to me, every team around the world at Hyatt was in discovery mode. All of the levers that they used to pull, all the algorithms and the models that we use to run the business, they were completely useless because the core customer base was not traveling. So they were in discovery mode. And in China, which was probably the most eye-opening one, the one that inspired me the most, the team in Shanghai, we have a local team in Shanghai that oversees all of our hotels in China. They said the best place for us to discover demand is WeChat. It's not our traditional channels. Even Ctrip, or now called Trip.com, which is the largest OTA in China, useless. We went to WeChat, and within 6 weeks, which is shocking, we were the first hotel company to stand up a flagship store in WeChat. In addition to that, WeChat agreed that anybody who came through that channel would automatically be enrolled in World of Hyatt. So we would actually be able to maintain contact with them, which is always a really challenging thing when you're dealing with third-party distribution channels. So we started, if you look at the prior year, because you can't really look at the beginning, January was still very soft in China in 2020. Don't forget, COVID broke out in China in October, November of 19. And so January was still weak, but by the time March rolled around, the country had shut down basically. And China was the strongest market we had in the world in 2020. We went from market share in 2019, same relevant periods, at 116% index. It means we had share 16% above our fair share to 136, moving 2,000 basis points of market share in the space of 9 months is insane. And a huge piece of that was WeChat. And this is the sort of innovation that, there's this expression called necessity is the mother of invention. And the team was sitting around saying, we have no clue. Like, we have no idea how we're going to find travelers. And they went to the biggest platform in China, thankfully. God, if they'd said no, I don't know what we would have done, but they said yes. And it remains one of our biggest channels in China today.
So COVID, of course, was a very, very negative, big shock, right? In your day-to-day, the way you manage the company, to what extent do you rely on sort of complicated scenario planning, or do you feel like having a lean organization is sort of the way you want to go? And just that's sort of more adaptable to things.
Look, the board of directors, you can imagine, they needed to know whether we were going to hit the wall, where were financial resources coming from. We immediately, and I had some experience with this in my prior life, I sat down with the finance team and the treasury team, and I said, we're going to move from an earnings-based planned company to a cash-based. That sounds really simple. But when you're in a crisis and you're consuming cash, which we were, you have to run the company by cash, not by what the P&L says. Cash is the only thing that matters. So it took us about 6 weeks to retool, and we weren't paying any attention to earnings reports anymore. It was 100% where are we in cash? Where are we consuming it? How are we getting it back in? Where do we stand? So we spent the first couple of months getting there. So by June, we were up and running and doing it this way. We forecasted out. At that time, we thought we would go through $1 billion in total. And thankfully, we went through a lot less than that, cumulative. But it was complete guesswork. Because don't forget, June and July of 2020, vaccines, nobody knew when, if, how vaccines would be available. It was complete and total guesswork. But again, when you go and sit down with a bank group or you go raise public debt, you have to be able to say something. So that was the only purpose for which we actually did a forecast at the time. Forecasting was a joke. I mean, it really was. There was no rhyme or reason or good basis for it. So I quickly came to understand, especially after the summer when I saw all this innovation going on in the company, that I didn't want to spend any time forecasting any longer. We were just going to rely on the first model that we had put together, and that was it. All we were going to do is focus on. So you know this, but I'm a huge fan of Satya Nadella's because he talks about growth mindset all the time. And I said, his famous quote, simple, very clear, and he actually executed against this. He said, I want Microsoft not to be the know-it-all company. I want it to be the learn-it-all company. Meaning, I don't want to show up as experts and think we know everything. I want to approach everything as if we're learning it anew. And that's what will unlock new ideation, innovation, and staying current. And I was so wowed by this that I said, that's it. That's what I just witnessed at Hyatt. It's here. I could feel it. That's what we need to do. Because scenario planning, and I still feel this way 4 years later, it's really a waste of time. I've been asked, so I was a whole week in Europe and then a whole week in Asia. And people were asking, so what scenario have you planned if Trump becomes president versus Kamala Harris? And they said, we've not spent any time working on any scenarios. And they were like, what? And I said, first, who knows who's going to win? Secondly, it's not going to be the day after whenever it's finally determined who's president, we're still going to work and working and doing our stuff. So what am I going to spend time speculating on that, how long it takes for the validation of the election and everything else? I said, really what I'm spending all my time doing is building that resiliency, adaptability, agility, and growth mindset into the company so that no matter what happens, we can be responsive. That's how I think, frankly, if I think more and more companies are realizing that that is actually the key thing, as opposed to, spending a lot of time doing scenario planning. If you're in a consumer business, if you're a pharma company and you've got development plans for new chemical entities and stuff like that, that's different. Like those are things you have to plan out. Not so much with consumer facing businesses.
So who do you define as your competitors? Do you follow them closely? Sort of in what time period?
Yeah, I mean, we operate in 70 countries. We have different primary competitors in different markets and at different segments. But globally, I would say Hilton and Marriott are our closest competitors. Hilton is about a little over 80% franchise. We're about 70% managed. Very different businesses. Hilton has about half of their hotels in a category called mid-scale and upper mid-scale. We have 0 in that category. We're all above that. Our portfolio is above that. So while they're a direct competitor, our profiles look very different. Marriott's closer to us in terms of what that profile looks like, but they're still more franchise focused and more mid-scale focused than we are. So we tend to have a higher rated, higher income level, higher household income and higher income level customer base. We're relatively stronger in luxury and lifestyle, and now resorts. If we close the deal that we just announced on Sunday, we'll be the largest all-inclusive resort brand management company in the world, which is, that in and of itself is not the be-all and end-all. It's really being the best. Being the biggest is oftentimes the booby prize because you become big and lumbering and process bound. So I just want to translate what we're doing into being the best at it. So those are the two primary competitors. And yeah, I pay attention to what they're doing. And there's a bit of resentment in my tone when I say this internally. We've had to do a number of things to play the game differently because we're smaller. We have 350,000 rooms and Marriott's got 1,300,000 rooms or something. So they're vastly bigger than we are. We have 1,350 hotels. They have 8,000, 9,000. So if what we try to do is emulate what they're doing, we lose the game. If we try to play against them on scale, we're done. So I'm always a believer in thinking about what are our attributes and how can we excel and be much, much better than any of our competitors, whether they be Four Seasons or Marriott or IHG or whomever. And oftentimes there's great concern if we propose to do something that members, colleagues of mine haven't seen before. Then my joke is, don't worry, as soon as Marriott launches something similar, everyone will sit back and say, oh, then it's okay. I don't know what that's called. There's got to be a term for this, like behavioral. It's not behavioral economics as much as it is behavioral employment. Maybe it's just growth mindset. I don't know. So that's the one thing that I resent because I don't like people not having the conviction or courage to be able to stand up and say, yeah, we can do this. And yes, we understand and believe it's going to actually add incremental value. We've done a lot of things in that category. And I think our team now is getting the benefit of the doubt that we propose to do different things. Like even going big into all-inclusive resorts in 2021, don't forget this is still in the middle of COVID. A lot of people were like, what the hell are we doing? We just bet the company on this deal and it's insane. And I think, we've generated a lot of value out of that transaction. So it's like, you have you got to prove it up, and then immediately afterwards, guess what? Headlines: Marriott entering all-inclusive space, Hilton building all-inclusive management capabilities. So everyone was like, "Oh, we're the leader, aren't we great?" And 3 months before, it was like, "What are we doing?" So it's like there's some interesting dynamics in terms of. That's why I'm going to talk to Richard Thaler about this.
Yeah.
There's an angle to this about behavioral employment, not just behavioral economics. There must be.
So the managed versus franchise, is that about quality control or sort of something you just firmly believe in as a model?
It's the way we grew up as a company. We weren't, since that whole category of upper mid-scale, and upscale, we have the 30% of our rooms that are franchised are the one level up from there, Hyatt Place and Hyatt House. So by virtue of the fact that we're not heavily concentrated there, we just have a much smaller franchise base. We have started to franchise Hyatt Regency, which is a full-service brand, but not anywhere to the degree that Hilton and Marriott franchise theirs. So we were late to the party in franchising. And I would say there are good things about franchising, there are bad things about franchising. Good thing is it's much less expensive to support a franchise organization, so your margins are higher. That's a selfish look. On behalf of guests and customers, I would say what you just said, which is quality control, is maybe more variable and harder to achieve because there are franchise rules that have very strict restrictions between in terms of what the franchisor can do in a franchisee's business. So you have to keep your distance and not end up having like an alter, what do they call it? Like an alter ego relationship with your franchisee, because then you just get treated like the owner of everything. Multi-employer legislation right now that all of the quick serve restaurants like McDonald's and Yum Brands, and they're crazed about because the government has asserted that if you're a franchisor, they're actually trying to legislate that you have absolute responsibility for wages, benefits in the event that the franchisee fails or something happens to it. So you become the guarantor of a gargantuan amount of liabilities. So there's a fight about that. Anyway, so those are some of the differences.
And where do you see like an Airbnb in that space? Do you view them as competitors or not really?
Increasingly, no. I actually admired Airbnb when they launched because I thought they built a better front end than any other OTA. I know they always resist saying that they're an OTA, but in some ways they are. It's just that the product that they're selling is apartments or houses or rooms. So the front end was excellent, much better than any other front end you'd see from Expedia or Booking or anyone else. Secondly, it was kind of inspiring. It was like, you're unleashing this sense of discovery. You're giving an opportunity for hosts to, make some money, but also be your local Sherpa for the neighborhood. I thought it all was like attractive, right? But then it got contorted, and a lot of corporate-owned apartment buildings were fully converted into like Uber hotels. And when that happened, by the way, that's been rectified because legislation has been passed in almost every major city in which Airbnb operates. But when that happened, I was like, well, wait a second. Now this is not okay because they're basically running a hotel without any of our fire and life safety restrictions, without any of the taxation that we have to put up with, without anything, and without any guarantee of safety and security. And we all know the parties that got out of hand or stuff that happened. So I think Airbnb has evolved enormously since the time they were founded. They went up a curve that was, in my opinion, probably ill-advised, although grew scale. They got legislated back to a different place. And now they're trying to get into business applications, purpose of visit. But I think that's hard fought relative to going to a hotel, especially for shorter trips. And secondly, the lack of control over the inventory, I think, or just quality control over the inventory is inherently going to be weaker. They're not really betting the brand on the quality of the underlying inventory. We are.
Let me ask you one last question and then turn it open. And so you've been associated with the school for a long time. You were, member of the Booth Council, and your wife, Rachel Kohler, she's a member of the university's Board of Trustees. So to sort of what makes you sort of give back to the university so much? So what's the connection?
I would say personal friendships and this is going to sound unduly complimentary since you're sitting here, but just the inherent quality and inspirational insights that you get just by having regular conversations with people who are superb and exemplary in their fields. And I think Chicago, I went to Harvard undergrad, so, you might think, well, maybe I think Harvard's the be-all and end-all. I think University of Chicago actually has a evidence of excellence in a different realm. Very different schools, very, very different schools. But the level of excellence that I consistently experience, and some really, like I was telling Raghu Rajan is like, I am such a fanboy of his. I can't even describe it. Every time I get to see him and go up to him and talk to him for even just 5 minutes, I'm like, I want to hear what's on your mind. That's all. Anil Keshav, who's not teaching at the school at the time that I was here, first of all, he's quirky and he's funny and a fun guy, but he's also freaking brilliant. So, I mean, the school's just packed with people that you can learn from. And I just think the level of quality is really high and it feels good.
So with that, let me open it up.
I would also say, you guys may not realize this or think about it this way, but as a Chicagoan, I think University of Chicago plays a disproportionate role in the social fabric of the South Side of Chicago. And I think that's actually really important too.
All right. Yeah, go ahead.
Really impressive speech, Mark. And the question I have is about how you raising fund during COVID. How do you raising fund during COVID? It seems like a mission impossible. And how do you draft your strategy? And can you list some key factors to help you secure the deal?
Yeah. So the way that secured debt. So we converted away from early in my tenure. I said, we're not going to have any secured debt. We're going to have a property because we owned a lot of real estate properties. And I said, I want nothing but unsecured debt. And I want to maintain investment grade, period. Why? Because we're in a cyclical, but 2 rules. We're in a cyclical business. Second, never, ever, ever forget the first rule. Because I've seen a lot of cyclical businesses think, oh, no, this is like, we can project out in time, and they get carried out feet first because they over-levered. So investment grade was critical, and unsecured was critical. Well, yes, it was not bondholder friendly, but we had a whole bunch of assets we could pledge. So that became the basis on which we could actually raise new money that was not structurally senior, but effectively senior, because they get to hold the property and own it as security. Now, valuing a hotel property in April and May of 2020 was like guesswork. So we ended up having to over-collateralize to a significant extent just to get that money raised. The reason I was so clear about going after it, though, the capital markets had literally shut down. We were talking about, major companies having to cancel their CP programs. And for some companies, that was commercial paper. That was a major issue. I thought, shit, we could see a bond market that's closed for our kind of company for a long time. And I'm not, we got cash, but I want to add as much cash as we can as soon as possible. And that's really why I did that.
Hello. Hi. Really enjoyed your questions and answers here. Watched you in an interview in Wall Street Journal earlier this year. Really interesting idea about sort of being asset light and how your firm and you probably brought that under. I was wondering where, I guess, to what extent is selling that idea and started even from your tenure in 2006. To what extent was selling that idea, difficult, or was it a more widely accepted, with the inertia of the firm and the hotel industry as a general being very, very real estate heavy. Now you're real estate light. Could you sort of elaborate on that a little
Yeah,
bit?
I think from an investor perspective, it was pretty easy because they were all demanding it anyway. Because Hilton, Marriott, and IHG had sold off the vast majority of their properties. It's a higher margin, higher conversion rate between earnings and cash flow. So those are the reasons why investors pick it. We did it deliberately and over time. So I had to resist actually calls to go faster. And the reason I did it is because we're of a certain size. We were making our EBITDA was in the range of $700 to $800 million. I wanted to maintain that because you sell a property and your earnings go down. That means your borrowing capacity, your balance sheet capacity has gone down. So what I wanted to do is put our company on a glide path. So as earnings from sold properties came down, earnings from our management franchise fee business went up, and that we maintained or grew our total earnings base to maintain borrowing capacity and financial capacity. Why? Because some of the things that come up are relatively big checks and you want to be able to act quickly. So we did individual property purchases. The biggest one we ever did was $700 million. We wrote a check. We showed up and said, no contingencies. We'll finish diligence in 3 weeks, 4, and we'll negotiate the contract and we'll close. There's no financing contingency. That mattered a lot in that case. That's how the Hyatt Regency Orlando, which is our biggest convention hotel in Orlando, came to be. We then went and bought some other asset-light platforms, also all cash, except for the all-inclusive business that we bought, ALG, Apple Leisure Group. That was big. It was $2.7 billion, and we had to finance it in the middle of COVID, which was not trivial. So unusually, we actually issued some shares to balance out the risk, which is not popular with existing shareholders. We issued stock at $74.50, and we're now at $146 a share, down unfortunately from $157 because we had a terrible reaction to our earnings report on Thursday. Anyway, one day we'll move on, but that's the answer. Yeah. Good.
Mark, thank you so much for speaking to us. My question is about managing different stakeholders in your work. Like you have a long history with risk organization. Now you're an executive kind of representing Hyatt. How do you manage maybe conflicting interests sometimes, like navigating through like long-term, what's good, like long-term for the family versus like short-term good for the business? Like what's your kind of ethos about it?
Yeah, I guess I will admit that we've had an unfair advantage having a majority shareholder because the Pritzker family members still own more than 50% of the stock. That has allowed us to play the long game, so to speak. So we have run the company for value creation and growth over time, not just the next quarter. And some of the investments that we've made took time to realize the value of. And there's a tremendous value in that. If you're chasing the next subsequent quarter and that's how you run the company, it becomes much more challenging, especially if you're a company of our size. If you're a company and you've got a $1 trillion market cap and you've got some long-rated bets that you want to make, you can do that. But interestingly, even Alphabet, with its size, scale, cash flow, and everything else, they created that's what they called it. It was like their skunk works for investments. They ended up cutting that back because they were getting a lot of pressure from shareholders. I think that's actually insane. I mean, I think if you have a management team who's innovated and created whole industries, which they have, and they continue to build strength upon strength, giving them leeway to invest in things that may be money losing for a chunk of time or maybe for a very long time. I mean, hell, Amazon lost money for the first 20 years of its existence. Think about that. And stock never took a hit somehow. I think Jeff Bezos was the magician of all magicians when it came to that. So I'm a big believer of giving teams who have proven themselves, not a flyer that you can't tell who you're dealing with, more room. because, not everything's created in quarterly increments. And so that's one of the problems that we got a lot of short-sightedness and a lot of what have you done for me lately kind of thing. And that's actually what we experienced. Our stock was down 7% on Thursday. It was my 59th earnings call. So I become a little inured to day of reactions. But, I understand where people are coming from, and we've got some rectification work in terms of getting them over the learning curve. But I do think that, really thinking hard about things that, yes, and like you can serve the quarter, but also continue to make investments where they're important.
Thanks for being here. I'm curious to get your thoughts on the loyalty program. So one of the trends we're seeing in travel and hospitality is just the massive monetization of loyalty programs. For instance, the Delta American Express partnership, which generates billions of dollars for Delta. So I'm curious to get your thoughts on whether, you think World of Hyatt is achieving, the financial objectives or the customer satisfaction, and to what extent do you see Delta, SkyMiles, airline loyalty programs as a North Star for how you want to evolve World of Hyatt?
Yeah. So we can see our loyalty program, which used to be called Gold Passport, started in 1984, and it was a traditional points program. In 2015, we relaunched Gold Passport. It actually went live in 2016. And Gold Passport became World of Hyatt. Excuse me. And at that time, the mandate was we're not going to render our relationship with our most loyal guests into a nominal dollar figure or into a balance of points. We want this to be a gateway to experiences, like an experience platform where they could discover new things, including new brands, new segments, new countries. But that's all on the hotel side. But now WellBeing is infused in a lot of the things that we're doing across the company. That's what I was interested in, because that's true loyalty. That's not how much can I get for these points. If you read the blogs, like the Points Guy or 1 Mile at a Time or whatever, they write about, they have very, pretty sophisticated model of valuing points. Our points are worth 2 or 3 times what the other hotel program points are worth, but that's because of how we run the program. And the dollar level at which we sell hotel rooms. That in and of itself is not a measure of loyalty or anything else. It's a measure of how we actually structured the program. So to my way of thinking, it's critical. A lot of the revenues that hotel companies derive, the revenues that they get to keep, come from credit cards, the co-branded credit cards. That's really, really where the value is. The other ways that some of the bigger companies that have huge point balances, billions of dollars of point balances, have managed have been to create conversion opportunities. So United Airlines was the largest magazine subscription company in the country. United Airlines was. Why? Because they did a deal with a bunch of publishers and said, we'll allow points to be converted in order for you to sell subscriptions. The magazine publishers liked it because subscriptions were going down. And it worked because people said, well, I don't know if I'm ever going to use these miles anyway. So yeah, they're discounted, but sure, I'll take whatever, Popular Mechanics. And that's not a game that we want to play. Like Hilton did an exchange into, maybe they did it with Prime. I can't remember with whom they did it. It was a major retailer. And I was like, I just don't see that as value additive for our customer base. I want to give them more things that they can do with their points as an experiential matter. There's a question down here, by the way.
Yeah, we have one there and then we'll come to you.
Thank you again for being here today. From 2006 to now, I'm sure not only has the world changed a lot, but probably yourself and your skills and how you view your role has changed. Could you maybe speak a bit more to that and I suppose where you're trying to learn or develop your skill set now?
Yeah, I think the thing that it's not just when I joined, I think the value of ignorance and thinking about learning continues to be true for me every day of my life. So I do feel like, I hope if Satya sat down with me and interviewed me for several hours, not on camera or anything, and I hope and pray he would come out of it and say, yeah, you've got a learner's mindset and I'm proud of you or something, like, because I really admire the guy. He did something incredible. But it's not because I want his approbation. I would say, I just find it essential. Like anytime I find myself saying, well, I know that this is the answer and let's go prove it up, I stop myself and I say, actually, I'm not sure that that's the answer any longer. Or how do I know that if we leave this open in discussion, some other member of the team is going to come up with something, a new angle on the same issue and look at it differently. By the way, it happens a lot, but you have to create space for it. And so I think the biggest issue that it is a behavior, it's a leadership behavior issue. You can't, leaders got to elevated levels in the organization through their expertise and their knowledge base. They became masters of their domain and they gave direction. That's how it used to work. Now they're expected to coach, mentor, and learn. They're co-learners with their own teams. It's a big, big transition. Not everyone makes it, by the way. Some people are like, you know, you've moved my cheese on me and now I'm supposed to what? Listen to opinions coming from people who've worked here for 3 years and I've been here for 35? The answer is yeah, and you're going to learn a lot if you keep your ears open. So it's not easy to make this transition. It's a big cultural shift, but I still think that's my MO. To wake up every morning wondering, what else I'm going to be surprised by that day in terms of new revelations about how things are actually working. A lot of it's consumer behavior driven too. Consumers are behaving very differently these days.
For someone working for a family business, and with the family members actually owning a significant chunk of the shares, how do you manage the agency or the interference when it comes to like taking the company in a different strategic direction as compared to what you and the executive team are actually thinking? How do you manage that stakeholder from the family side?
Yeah. So I'm really thrilled to tell you that I haven't had to manage any conflict at all. The Pritzker family members who are still big investors in the company are all long-term investors. So we haven't had any strategic disagreements about the right direction to take the company and their views. They happen to be aligned. Secondly, I'm not going to go through the whole thing, but basically when we put the shareholding structure together before we took the company public, we created two classes of stock. The Pritzker shares and shares owned by a Japanese group that we sold shares to some time ago have 10 votes per share, and all the other shares have 1 vote per share. However, in the shareholders agreement, there's a voting agreement. That voting agreement says that if you're a Pritzker family holder, you have 10 votes per share, you cede your voting, give it over to the board of directors, a majority of the independent directors of the board. Think about that. If you were Tom Pritzker, in 23% of the company or 24% of the company, you have like 75 or 80% of the vote. Actually, you have no vote whatsoever. You've given up your vote. The people who actually vote those shares are a majority of the independent directors of the board. So if you think through that and the implications of that, the board really runs this company. I mean, I shouldn't say run it. We run the company. We report to a board who's responsible for all shareholders, all. But the Pritzkers don't exercise control, traditionally speaking. You could say, yeah, but Tom Pritzker gets to decide who's on the board. Yes, he does. But it's a very unusual structure, first. Secondly, we just haven't had to manage a conflict because I think Tom and I are very aligned. We've worked together for 35 years. I think that matters. But we just haven't had to so far, thankfully, because I know there are a lot of other examples out there, the Redstones and a bunch of other people, where it gets super contorted very fast. And thank God I don't have to deal with it.
Thanks for your sharing. I'm Clara. So my question is about like what strategies does Hyatt use to leverage the ads to drive like both short-term customer acquisition or the long-term brand loyalty?
And so
As advertising.
Advertising.
Yeah.
Oh, I think a lot of what we do by way of advertising is sort of, first of all, it's all virtually all digital. I think we have a tiny budget for print, no budget for TV. And so almost all of it's digital, and a lot of it is personalized to your stay patterns and what brands you frequent and what your travel patterns look like. So a lot of it is inviting you to explore the world of Hyatt. I don't mean the loyalty program, I mean the small W world of Hyatt. And to appeal to things that you seem to be particularly interested in. And increasingly, we're paying really close attention to people's lean into well-being. Because we have a particular strength in well-being because we bought Miraval and some other brands to help build out our capability set. And I think that well-being is a mega trend into the future that we will be able to really differentiate ourselves along. So a lot of it's in that domain. We're doing a lot of work using AI models, including generative AI, to better learn quickly and test and learn a number of different approaches to how you might personalize someone's journey through our website or through the app or through their engagement with the company. So I'm very excited about those things, but it's still relatively early days.
So we have time for one last question, I think. Okay. Yep. Good.
Thank you for the insightful session. You've mentioned about the successful programs like the all-inclusive resort. On that lens, have any initiatives been not so successful, the ones that you've launched first? And if yes, how have you not let that affect launching further new initiatives the first time in the industry?
Yeah, I'll give you 3 examples. So the first one, 2 examples of things that didn't work, and then I'm not going to talk about ALG again because that's turned out to be very successful, and a lot of our competitors have followed us. So if I go back, at one point, we were absent in so many major cities, and we did it by MSMA globally. And in one case, we bought a hotel in Mexico City where we had been absent for 25 years. At the time we did that deal, it was the 5th largest MSMA in the world. And that turned out to be a great success. So we thought, okay, we'll do more of this. But then we hit some markets, and Rio is the one that it's hard for me to talk about because it really killed me. Rio de Janeiro. We had no presence there. We had to be on the beach. Ipanema and Copacabana Beach, they're all packed. There's no real estate. So we ended up buying a parcel in an up-and-coming neighborhood where a lot of the Olympic Games were going to be held and so forth and so on. We bought it. We built a hotel. Stress. It took us at least twice as long, cost more than twice as much as we bargained. And the principal reason is Foreign Corrupt Practices Act. Because Brazil, it turns out, idiot me should have thought about this and known, everyone gets paid off for anything and everything you can possibly imagine. And we couldn't do business that way. And so we got killed, absolutely destroyed. Bad news, costs us a lot of money. Some saving news on that is it wasn't such a big mistake that it was ever a massive risk to the company at large. But that was the last hotel we ever developed anywhere. Because I said, this is just stupid for us to try to play developer and build anything, anywhere, even in the United States. We had one hotel in Philadelphia that was still under construction. I said to the whole company, we're going to shut down our construction. The minute that hotel opens, the construction department is going to go. We're no longer going to do this ever, period, end of story. We've stuck to it. So that was an initiative that I thought, oh, well, we'll just go and develop the hotels in those key markets. No, can't do that. The second one was I would say that the well-being bet that we made was in 2017. We bought Miraval. And I was so convinced. So many things indicated that people were going to lean into the well-being much more significantly, holistically. We did a whole survey of all the brands that were out there. Most of the brands only had one hotel, including Miraval at the time. So they were brands, they were really outsized in their brand equity and brand awareness, but really small. But we were looking for differentiation. The differentiation we found in Miraval was mindfulness, a mindful way to eat, a mindful way to move, a mindful way to exercise, a mindful way to care for your mental health, a lot of meditation-based programs, and a lot of experiential things that were designed to help you discover more about yourself, find your own balance, basically. So we like that positioning. It was a live and let live environment, unlike Canyon Ranch, which was highly prescriptive. We said, okay, this is leverageable. For 6 or 7 years in a row, we ended up building out the other 2 resorts that we bought the company with. And that took longer than expected. Again, don't do construction unless you're in the construction business. But I would say my call at the time, and we as a team, our call in 2017 was, this is actually going to be observable and actionable within 3 or 4 years. 3 or 4 years was 2020. It took until 2022, 3 for our corporate customers, our largest corporate customers, top 10 customers coming to us and saying, hey, we need to pivot hard because we've gone to these remote work practices and we are really concerned about mental health and well-being for our employees. These are companies like the big 4 accounting firms, the biggest in the country, systems integration companies, the technology companies. Their principal asset, people. Their principal playing field, especially in 21, when you couldn't hire anybody for anything, was competing for talent, or 22 as well. And so they were coming to us saying, okay, we desperately need to put something together immediately to lean into their well-being. And all of a sudden, it exploded. So we were doing programs for those customers, those types of customers at scale. We created a meetings platform called Together by Hyatt, which infuses well-being practices into meetings, corporate meetings. We've sold over $1.5 billion worth of those meetings, primarily because people felt like they could actually program in well-being practices, like simple things. Starting the meeting with setting intention. You don't do anything. You don't get into content. You don't do anything. You start the meeting with setting intention, and the intention that gets set, you can do it in a way so that everyone actually gets aligned around that intention. And our own group customers are saying it's made a huge difference. Our meetings are much more productive, et cetera, et cetera. This is not, by the way, we left a yoga mat in your room. Enjoy it. That's what the old style well-being stuff was about. Or go for a run tomorrow morning. Like, good on you. This is much more intentional towards productivity of meetings, and it's just been great. So I would say we were wrong because it took much longer for it to happen. And frankly, had COVID not happened, I'm not sure that we would have seen this massive acceleration. So I guess I still believe that it would have come at some point, but some of these are really hard to call in terms of when they actually go into it. I talked to Ginny Remedia extensively about this. She was the former chairman and CEO of IBM. They've been in AI for 2 decades. Watson was like the first example of this, right? They were so early, painfully early, because people were really skeptical, like, okay, you built this thing, how do you use it? Like, and then all of a sudden Gen AI comes along and the IBMers are sitting back and saying, where have you all been? It's been around forever. So this is, and she sweats that too, because she was there when Watson was really getting, it was one of her core things that she leaned into. So we've spent a lot of time talking to each other about, there's resolve, and then there's managing investors, and then there's, relative investments that you're making. These are complicated things that you have to manage through, always kind of keeping tabs on what the demand was. So it's not, I don't have a simple answer for you. It's complicated. But I still believe that back to this question that you asked earlier about like making long bets and playing for the long term versus short termism, there's still a role for that.
Great, thank you. That was incredibly insightful. Thank you so much for coming here. Really value. They have class at 1:30. Oh, yeah.
Get out of here. Go to.
Thank you. Thank you. Thank you so much. No. I don't know.
I really like mornings.